Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of LME 3-month copper, aluminium and lead.
LME 3-month copper. The break above the third of three resistances, the neckline of the February to April 2023 head and shoulders continuation pattern, currently at 84.91, back at the start of March, was the beginning of this recent move higher. This neckline had previously helped cap the market in various times, most recently in late January and late February. However, 8 weeks ago, this resistance was breached and broken. So from where in price does this recent move higher originate from? Well, it starts at the base of the congestion between 83.46 to 84.40, containing the September 2012 high at 84.24, the February 2013 high at 83.50, back then the long moving average currently at 85.22, as well as back then the medium moving average currently 87.60. However, the journey higher had been initially a tortuous one. Yet in late February, the market built on the congestion below 84.40, plus the short medium moving average back then, currently at 90.23, and finally a golden cross at the time of the medium moving average up over the long moving average just over 8 weeks ago, and staged an eventual move up over the neckline. So what now? Well, there are two parts to the answer. Back 7 weeks ago, I said the following one, I quote, "If the action of the last 3 weeks," so that is 7 weeks ago now, "if the action of the last 3 weeks may have left us with a question, is this action a bullish halfway hesitation or a potential double top?" Well, end of quote. Well, this pattern became a bullish halfway hesitation, and I noted down 3 weeks ago that the primary target, and I quote, for such a pattern already achieved in the 93.70 area. However, secondary, a more extensive target X, a harder to reach target, is up in the 95.50 area for the same extended pattern. It is synonymous with the 2023 high, and that's the end of the quote. 2 and a bit weeks ago, the market reached the harder to reach secondary target. It was achieved. Since then, we have seen prices travel higher and today reach the February 2023 high and indeed the whole of 2023 high at 10.208. Let's call it 10.210. It's probably easier just to call it that rather than split it in the hairs. The second part has been the treatment of the action over the whole of March, in that we have a beautiful, if very acute, March-based bullish Andrews pitchfork highlighted in dark blue on my daily chart. The market is at the moment close to the middle time, currently at 99.36, with the upper time above currently at 10.270, acting as a resistance. And the lower time currently at 96.04, some distance below. Together they have been and still are showing the excellent bullish angle of attack of this market and will do so until they fail, and that's something to watch out for. LME 3-month aluminium. I have in the past kept repeating myself here. There was, and suppose still is, a lot going on here, and I sometimes thought, my trying to explain it may even have made it more complicated. Anyway, things have become a lot clearer recently. I'll start with my commentary from 12 weeks ago. Yes, 12 weeks ago. When I said the following, when I quote, "Over this last week," so that's 13 weeks ago, "over this last week, another pattern has started to develop in my mind. And I've drawn it unhighlighted on my daily chart. It's a late October 2023 to date, potential diamond pattern. It is not a pretty pattern, but I would pay close attention to converging trend lines for this pattern. I'm not in love with this pattern. I will retire if it does not perform, but it does have merit and is one to watch. End of quote. 9 weeks ago, I chose to highlight this pattern in dark blue on my daily chart. It is still highlighted the same as it was then. I grant you, it's still not the best looking diamond pattern type, but as I said earlier, it did and still does have merit, especially on this break higher. Thus, 6 weeks ago, I laid out some potentials topside for such a pattern. Hence, we would have a primary target X in the 2412 area and a secondary harder to reach target up in the 2491 area. Boy, did this market take its own sweet time in moving up to these targets, but get up there it did. Up to target X 4 weeks ago and up to target X1 3 weeks ago. And that's the one at 2491, the last one. Now, I also pointed out two features 6 weeks ago, and I quote, "The first might end up being a big thing in the future." We had a bow tie formation late 2 weeks ago, so that's now 7 weeks ago. Late 2 weeks ago, of the rising short moving average, that's currently at 25.46, slowly rising short medium moving average, currently at 23.56, and the barely rising, well, it's rising now, the barely rising medium moving average, currently at 23.02. For any who follow bow tie formations, you can easily see that these moving averages are in the wrong order. However, that being said, the theory indicates that the market will move in the general direction of the outgoing moving averages from the bow tie, which, to be honest, originally looked sideways, but now is becoming clearer as a move higher. Additionally, between 15 to 20 sessions after the crossover, we may see a significant move from this bow tie. In this case, and allowing for some holidays in between, the market may have a move between the 9th and the 16th of April. I'll not await with bated breath, as I am not happy about this bow tie formation at all. Finally, we had a golden cross last week of the short medium moving average up over the medium moving average. This may be a lagging indicator, but it's still there just after a bow tie formation, and it adds some comfort to the overall idea. End of quote. Well, you can easily see that between the 12th and the 15th of April, we had a big gap higher, and the 15th itself was a huge range, something in the order of 7.5% in 1 day, despite ending up as an indecisive doji cross at the end. How's that? Okay, all that is fine, but what now? Well, I suggest the 15th showed the extent of the recent market on the top side, and we have seen a peaking action over the last 2 weeks. It is not as clear as seen in LME copper, but it has elements of a potential top. If this is to happen, then we need to see the gap in mid-April between 25.12 to 25.35. We need to see this filled in, and relatively soon. If after this the market continues lower, then recent action will have been a peak. If not, then this may become a staging point, even a possible halfway hesitation for a move higher. I'm just preparing you for the opportunities. The only issue will be if the market takes off higher in the next week or so, in which case we will have to balance the bullish potential of a possible halfway hesitation with the bearishness invoked by descending highs that we have seen in April. LME 3-month lead. In late January, prices dropped out of a December 2023 to January 2024 based bull channel, all the way down to the congestion around 2000 in mid-February. This support was not a spectacular congestion, but enough to hold prices in a pipe bottom. After this, the market rose up into a very steep ascending wedge pattern before breaking lower again at the end of February, only to be held at the same support seen back at the start of this year, the January 2020 high at 2039, and leading to a fresh rally. This rally saw the market break higher, over the 50% Fibonacci line of the March 2020 to March 2022 move at 2135, and the 50% Fibonacci line of the May to November 2023 move at 2142, and even the November 2023 to February 2024 move at 2151. However, as I said 7 weeks ago, and I quote, I suspect the key overhead resistance will be the same as in late January, the congestion between 2182 to 2189, end of quote. Now please remember this quote, as it will become relevant again. Prices made a peak in the middle of March with a high that was importantly lower, and I can't stress this highly enough, a high that was lower than the one in late January. Prices then dropped down below all the moving averages, below the January 2020 high at 2039 and almost down to the February low at 1994, enough to say prices effectively reached it. 5 weeks ago, I put forward a question, and I quote, "All this action is making the big picture very clouded. All I have now is a consideration that perhaps, just perhaps, the action since November last year is a really big cat's ears pattern. It is too early to know just yet, but I would like to lodge that thought in your minds just in case," end of quote. 4 weeks ago, we were close enough to the lows for me to consider that, but then we had a dramatic counter-to-counter daily key reversal up that halted that day at the short medium moving average, up there at the time at, it's currently at 2108. What is more, prices after this move higher utilized the short medium moving average as a base. All this bullish action kicked out the idea of a big cat's ears pattern, and instead brought forward the idea of a late January to mid-April double bottom pattern type. It is here that I bring back in the earlier quote made 7 weeks ago, and I quote, "I suspect the key overhead resistance will be the same as in late January, the congestion between 2182 to 2189, end of quote. There's been this overhead congestion that capped the market throughout the beginning and middle of April, bar one aberration, until last week. We are now over this area of resistance, so it's appropriate to consider it as support, and also to consider the upside potential for this big double bottom pattern that has occupied a third of 2024. Thus, the primary target X would be in the 2296 area, whilst the secondary, much harder to reach target X1 would be up in the 2342 area. Okay, all that being said, let's look at some other features that have emerged. And first off, we have spearing through the recent action in purple, the lower trendline extension of the May to June 2021 descending triangle, currently at 2206. This is acting as a resistance upon the current market. Next is the handle. Now, the handle is a feature of double bottoms, especially Adam and Adam types, such as the one we have. It is a band of hesitation seen on my chart between 2182 to 2189, and the twin 50% Fibonacci lines below. So it's between roughly the overhead congestion between 2182 to 2189, and between the twin Fibonacci 50% Fibonacci levels below at 2151 to 2142. So 2182.89 down to 2151.42 area. This is intrinsic to the double bottom, but it can also be seen as potential halfway hesitation. Thus, if we look at it that way, and depending where we measure it from, we have a first target in the 2240 area that's already been achieved, and a second possibly in the 2325 area. They aren't good enough for a target as yet, but well worth remembering and keeping an eye upon. Finally, the elephant in the room, the bright red highlighted mid-February to late March bullish Andrews pitchfork. This looks good right now, with the market in between the middle time below, currently at 2174, and the upper time above, currently at 2281, and showing the bullish angle of attack of the recent market.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.